Principal or interest only? How should you set up your home loan? Well, today we're going to go through exactly that and run through the pros and cons of each.
So when is the right time to use interest-only repayments versus principal and interest? Let's start with the differences between the two. Typically, a normal home loan is set up on principal and interest repayments. The principal is the amount that you owe and interest is what you're paying to the bank. The loan is typically set up over a 25 or 30-year term, where at the end of that term, if it's principal and interest, you owe $0. So as you can see here from this chart, you might start with a loan of $300,000 and over 30 years, the amount owing goes down to $0. On an interest only though, you're only paying the interest and not the loan itself or the principal. So in that case, if it's interest only, you end up not paying any of the loan down over that 25 or 30 year period, hypothetically. But the downside is you pay significantly more interest because the loan is not getting paid down progressively.
So let's start off by looking at the pros of interest-only loans. The first is if you have an existing property and you're turning it into an investment. Now, typically as an investor, there are advantages to having an interest-only loan because the interest you get charged is a deduction. And if you have an existing owner-occupier at the same time, most people will put all their money towards their owner-occupier and let their investment stay on interest only. This also frees up cash flow month to month, week to week. The second advantage is if you have a temporary fall in income. We saw this a lot with COVID, where we saw the banks give home buyers reprieve by allowing them to reduce their repayments to either interest only or even lower. So if you have a temporary shortfall in income, you lose your job, you can actually call the bank and ask them to change your loan to interest only.
But the negative of doing this is potentially your repayments going to be higher when the interest only period ends. Later on in the video, we're going through an actual scenario to see the differences between starting with principal interest or going 5 years interest only and what impact that has on the cost and repayments after the interest only period. So stick around.
And the last advantage of going interest only is if you've recently done a large renovation or you're doing a construction, you can actually make your loan interest only during that period where you know you're going to have higher expenses. Another example of that of having higher expenses is what's happened recently with all the flooding, where you might find that you've got higher expenses to renovate the home and you need some reprieve from the mortgage to reduce those repayments. You can opt to go interest only for a short period of time. Now, the biggest detractor or con with interest-only lending is that the interest rates are far higher, and as Jaden will go through in an example later, is that you're actually not paying down the debt, so when you move from interest-only to principal and interest, you can have a fair bit of payment shock.
And the practical costs over the life of the loan are way higher when you go interest only. The main reason is, like I said earlier, the balance of the loan isn't going down over 30 years and the amount you're paying on interest isn't going down, it stays the same. So we'll go through an actual scenario of this later on.
And lastly, the banks have actually cracked down on interest-only loans for owner-occupiers. So it is even more challenging if you are wanting an interest-only loan and you're a first home buyer or a home buyer. The banks are actually starting to crack down and say, no, we're not interested in doing that there.
Now let's look at some of the benefits or pros of principal and interest repayments. Obviously, the biggest pro of principal and interest is that you're paying off the debt, and at the end of the 25 or 30 year period, you will completely own that property. You'll have no debt owing, versus interest only, where you'll still owe the same amount of principal you initially took out.
Another advantage with going principal and interest is that you can get higher leverage on the property. For example, some lenders won't let you go above 80% lend for an interest-only loan. With principal and interest, you can actually go right up to 95%. So if you do have a minimal deposit and you're looking to buy, this can be a huge difference between being able to get in the market and not.
Also to this point, you potentially will have a higher borrowing capacity when doing principal and interest repayments. The main reason is the banks, when calculating your serviceability, will calculate your serviceability on repayments on a 30-year principal and interest term if you're doing P&I. Compared to interest only, where say maybe you might do 10 years of interest only, the bank's going to calculate your repayments based on a 20-year loan term. So in this example, if the bank was using a 5% reference rate over 30 years, they're calculating your repayments on a principal and interest loan at $1,610 per month. But if you did an interest only loan with 10 years interest only, they calculate it on the remaining term, or 20 years. So instead of being $1,600, your borrowing capacity is lower because the repayments are higher by about $300. So interest only can actually reduce and make a big impact on your borrowing capacity when you're looking at loan options.
Adding to that point, we do have a lot of home buyers that actually think interest only lending helps with their borrowing power. But as you can see in that example, the bank doesn't look at it as your repayment right now. they're looking at what your repayment will be when the interest only ends. So a good point there, it does help increase your borrowing power when you are on a principal and interest repayment.
Another pro of principal and interest is you get reduced interest rates. In general, principal and interest rates are around 0.5% less than those of interest only. So for example, on principal and interest, you might be paying 3% or $1,264 per month. If you go to interest only, it could jack your rate up to 3.5%, but your repayments are $875. It's still an extra cost that you're having to pay, and over the life of the loan could make a big difference. So definitely get your mortgage broker to factor this in when you're looking at these options.
And the last advantage of going with principal and interest is that there's not going to be any repayment shock. Now, this is a big one we see with interest-only customers. When their interest-only term ends, the banks usually won't let you extend if you've had your interest-only period for more than 5 or 10 years. What happens here is there's a massive repayment shock because you go from paying the minimum repayments on interest only to now paying the debt over 20 years. This is where we see a lot of our home buyers or investors looking to sell because they can't afford it, or they try and refinance to get that reprieve.
So let's go through an actual example of what Nathan just explained then. So in this example, Pam and Ivy borrowed $500,000 on a 30-year variable loan term. So in the case of it being a home loan, on principal and interest, their interest rate is say 5% and the repayments are $2,684 per month. Or if they go for interest only, on a higher interest rate as mentioned, the repayments are $2,312 per month, interest only. These are the monthly repayments either in principal and interest or interest only for the first 5 years. Most banks will only allow you to do up to 5 years interest only. After that period, like Nathan said, you have to either refinance or renegotiate. After the 5-year interest only period, as principal and interest, the loan balance has been going down. But in the case of interest only, it's still $500,000. So in the case where they've been paying principal and interest, the payments are still the same. They're $2,600 as they were in the beginning. But in interest only, the repayments go from $2,300. Because the loan balance hasn't gone down, it gets jacked up to $2,900, almost a $610 increase. The other thing you need to be careful of is because you haven't been paying down the loan balance or principal for the first 5 years as interest only, it can end up costing you a lot more over a 30-year period. So in the case over 30 years where you paid 5 years interest only, you're going to pay an extra $49,000 in interest by deferring the principal payments for 5 years. Now, like Nathan said, on an investment, it might not be a bad thing because you're looking at cash flow and it might make sense from a tax perspective, but for your home, it can cost you a lot of money and eat away at your equity. So it's something you definitely want to get advice from either your tax accountant, your financial planner, and your mortgage broker to confirm that makes sense for you. I guess that extra cost showed in another way using another bank's calculator. In this interest-only simulator, I'm borrowing $400,000 with my principal and interest repayment and interest only over 5 years. Because my loan balance stays at $400,000 for 5 years when it's interest only, it actually costs me an extra $35,000 by paying interest only. Now, the nice thing about this calculator is it actually breaks down how that amount is calculated. So as you can see here, of the $35,000, $25,000 has been incurred by not paying any principal during that term, and an extra $10,000 has been incurred by paying the higher rate with an interest-only home loan. So some banks actually make you sign a form acknowledging you're going to pay a bunch more money for the privilege of paying interest-only repayments. Like Nathan said earlier, it's very uncommon for a first home buyer to start their home loan with interest-only repayments. Mostly because you're generally going to need at least a 20% deposit to get access to that. And unless it's part of your financial plan, maybe for a cash flow reason, you might be doing dollar cost averaging with your shares and that sort of thing, it could make sense. For most people, principal and interest makes sense when it's your home and you're living in it, up until the point that it might turn to an investment property. At that stage, you might switch over to interest-only repayments for cash flow purposes because like Nathan said, you want to be paying down the non-tax deductible debt in most cases, which is your home loan. Obviously, that's general advice only, so chat to your financial planner or your accountant to see what's going to work best in your situation.
So, what do you think? Do you think interest-only loans or principal and interest is the way to go? Leave a comment down below. We'd love to know what you think. Did you know here at Hunter Galloway, we're mortgage brokers and help people right across Australia? So if you're looking for a mortgage broker and needing assistance, hit us up at huntergalloway.com.au or call us on 1300 088 065 and we'll see you next time.